if we go straight to thinking through these results, we see these are results that have been reported or recorded during a very challenging global macroeconomic environment. We are all aware of the challenges the global economy is going through. It has not fully recovered from the COVID impact, the Russia-Ukraine challenge, the supply chain disruptions, particularly in terms of energy, cereals, and more importantly, fertilizers to support the agricultural sector. And as a result, that continues to cause strain on the supply side. As a result, the macroeconomic prices and indicators, one would say we are living in very turbulent times. The interplay between inflation, exchange rate, and interest rates really reflect a perfect storm where all the three economic market prices are reflecting challenges. And as a result, we see particularly emerging economies, their currencies reflecting volatility, significant depreciation, globally high inflation in all economies, irrespective of the status of the economy. And as a result, high interest rates as governments try to manage, to tame, and to smoothen inflation impact that really affects disposable incomes among the populations. So this situation, as we can see, whether you look at US, UK, or the Eurozone, the numbers remain the same. Coming closer home, we see the government's all focused, concerted effort to manage this turbulence, and we see the focus on reducing deficits to really create physical buffers. Unfortunately, because we are coming from previous shocks, the buffers have been very thin, and as a result, there is a huge focus by all the governments in the region to manage deficits. And we see the very concerted effort giving us hope that we would eventually achieve a stable microeconomic environment. This has not detracted equity. We remain focused on the African Recovery and Resilience Plan, our strategy. And it's during difficult times that when you execute a strategy well, then it drives the transformation. So we feel a plan for African recovery and resilience is appropriate, and you see throughout the presentation that we have accelerated implementation so that we give the region an opportunity to keep, not only to keep the rights of the economies on, provide opportunities to the population, but also more importantly, partner with governments to get the recovery being realized faster. The involvement and engagement of an entire 300 million population in economic activities, using the social engine to catalyze change, to bring everybody to involvement, again shows the concerted effort that will be able to influence the direction that the region is likely to take. And that then gives us the interplay that we are seeing because of the effort of the group to execute, to sustain the resilient and recovery plan implementation. We see interest income growing quite fast at 27% because the group has sustained lending at 26%. And that's one would ask, how does a bank grow loans at 26% to earn 27% during such difficult times? It is simply because people require an umbrella when it is raining. You never take away an umbrella from people when it's raining. So we want to support businesses, we want to support communities, we want to support entrepreneurs so as to wade through this difficult and challenging time. And as a result, we see that the top line of the group has not been affected, consistently trading well. And as we can see, non-funded income growing much, much faster than interest income, suggesting the sensitivity of the group to bring affordability. And as a result, using non-funded tools, LCs, guarantees, letters of credit, as Frederick called them, to avoid exposing clients to interest expense. So that broadly is to support that top line. And that, if you do a bigger deep dive, you see trade finance is the fastest growing tool or financial tool to enable cross-border trade, again realizing the need to build local and regional value chains. And as a result, we can see trade finance, and we really can see at the national level, the country has reported a growth of 20% of cross-border African trade volume increase. And that maps very well to the initiative of the group to support the African Recovery and Resilient Plan, and particularly the cross-border trade. And really, this signifies the efforts of trade missions that the group has been involved in to really promote trade. As a result of that huge promotion of trade across the border, we see the treasury functions becoming very significant in the group. So it's treasury and trade finance becoming significant. We see forex income becoming a significant source of revenue because it's all about trade and trade within the region. And we can see, again, because of the macroeconomic environment, the yields on government securities have peaked up, and we see a 100 basis point increase in the entire yield of government securities. Again, looking at the trade finance aspect, the cross-border trade, we see the power of Equity Bank Kenya in driving that, then driving the growth of the subsidiaries. And we see that the subsidiaries, reflecting the geographical distribution, diversification, are now almost of the same size with Kenya. So almost 50% of the entire balance sheet of the group is now outside the Kenya banking subsidiary, which would likely be called the mother of this group. So the expansion has worked very well. And this has really placed the group very, very well, given that the subsidiaries are in the top 3 financial service providers in the countries they operate in. All 5 of the subsidiaries out of 6 are systemic, are in the top 3. And that again shows the capability of the group to support the regional trade. But looking then into the future, you recognize that this region, Eastern Central Africa, is the fastest growing region in the world. And as a result, when you have a systemic financial system in all the markets that constitute that region, it shows how well positioned the group is going forward into the future. If you look at the efficiency level of the group, it has been spread across the entire region, such that when the balance sheet contribution of the other subsidiaries other than Kenya is 46%, the contribution of the total revenue is at 45%, suggesting the efficiency of the processing and the speed at which the subsidiaries are becoming efficient, and that the subsidiaries are purely a reflection of a replication of the Kenyan model. So there is not much difference. It's just scaling Kenya and its efficiency. The model is the same. That's why when subsidiaries contribute 46% of the balance sheet, they also contribute 45% of the gross revenue. And consequently, what you achieve, if it is the subsidiaries are exactly similar, it's a replication, then what you focus on is then the efficiency, optimization, and agility of an entire balance sheet. And that is where the future of this group lies, that you grow efficiently, optimizing and enhancing productivity. And we see the agility of the balance sheet very, very well positioned to be very, very responsive. And we can see the structure that creates a 51% liquidity of an entire group balance sheet. So the allocation to fund opportunities becomes visible. We continue to register significant transformations using innovation tools, and we see the digital banking in terms of volume value handled. We are now on digital channels more than 2 times. Initially, we used to say low value transactions are on digital channels, but we now see that those digital channels are handling more than 2/3 of the entire volume of the group. So we continue to promote and build fintech capabilities, give alternative channels to our customers, a whole range of channels that enables customers to have choice, but more importantly, to meet the needs of different business segments. So this reflects the segmentation. But to an efficiency and cost structure, it means the group is quickly moving from fixed cost channels to variable cost channels to self-service channels. And so we could continue to see the same efficiency being unlocked going forward. And we see this has spread, including to lending substantially. There is a huge change in terms of the volume that is handled, other than just the number of loans processed and the fintech capabilities, the self-service. We also see the payments, the money transfer, huge volume being processed on these channels. Banking has become a 24-hour business, We have compressed distance, we have compressed time, and given people the ease, the convenience, and the freedom to their money. The integration with the global payment fintech capabilities again shows the readiness of the back end of Equity Group systems to be able to complete the transaction head-to-head. And we can see then as the country goes through the challenges of Forex, the group has been supported heavily by diaspora flows that has enabled us to keep the rights of the businesses of our customers on, providing them foreign currency as they require, and we can see the Forex trading income as a result playing a significant role in the structure of the entire income spectrum, and essentially contributing to enhancing the quality of earnings. When you look at the loan book, the way we have looked at the segmentation, we see the focus is heavily now on retail and micro, small, and medium enterprises, again, to support the value chains, to support ecosystem, and to reflect a change in strategy to ecosystem banking. And so we'll see more and more of that shift, and we can see the corporate shedding of control from 41% to 39%, as we see retail climb up from 27 to 28, micro and small from 25 to 26. This is a huge balance sheet. You're talking of a balance sheet of 1.7 trillion shillings. So a movement of 1 percentage point in one segment is very important. But it's the structure of the economy that we are supporting. So when you look at diversification of the economic sectors, it means nobody is being left behind. It's a balanced approach so that builds the mitigants. And we see the impact of that diversification among economic sectors when we look at the asset quality. And we see that despite the very challenging environment, the group is able to register a 9.8% NPLs against a national average of 15%. So we can see the rewards of strategy. That strategy that imbues diversification, helps to mitigate, but also the focus of our credit teams in supporting clients through relationship management to be able to manage portfolio. But as we can see, the group maintains resilience, prudence, and despite the fact that the quality of the loan book is fairly strong, the group maintains strong provisioning policies to ensure that the cost of risk is taken upfront in compliance with IFRS 17 in terms of risk recognition. When we look at efficiency, we see a consistency, and as a result, we can see the yields on earning assets stepping up. But because it is global macro environment, we see the cost of funds rising much faster than interest income, again reflecting the environment under which we are operating as a group. The group continues to focus on social impact, shared prosperity, to continue to build the brand, to continue to sustain and uphold the trust that the group enjoys. And that trust that the group enjoys is really reflected by global rating and accolades that the group continues to receive. the recognitions that it continues to receive, the performance of the group from a statistical point of view, giving the group a significant role to play as an influencer in the financial field because of its performance. And we continue to play that role diligently, knowing the responsibility that leadership bestowed. And when you look at the quality that Equity Bank has become, you see how significant the market prices that quality of the bank. If you look, the bank has a market cap as of 24th July of 167 billion shillings, followed by the second closest bank with a market cap of 95 billion shillings, suggesting even if you add the second two largest banks, they are still smaller in terms of market cap than Equity Group, showing the premium the market is willing to pay for two things: the strategy the group pursue, the quality of the assets of the group, and the quality of the strategy of the group. So we have always emphasized that the greatest asset of this group is its people. This is where people don't appear on the balance sheet. But look at how much value strategy, leadership, governance, and quality has been given. Equity Group is valued and priced higher than the two second largest banks in the Nairobi Stock Exchange. And when you look at, if we were to add the balance sheet, you would see it has nothing to do with asset size, it's the quality of strategy and balance sheet. But that quality, which I would translate into trust, how much trust the Equity Group enjoys in the markets that operates, then is very well reflected by the growth the group is experiencing during very difficult times. So when I look at the balance sheet, the total assets of the group has grown up to 1,645 billion, a growth of 23% at a time the market is experiencing turbulence. And as we can see, that is not matched by profitability because equity doesn't focus on profitability. Equity focuses on changing lives, giving dignity, and expanding opportunities. And that seems to resonate very well with the market, and as a result, equity in very difficult times experiences a 23% growth in total assets or growth in balance sheet. When you look at what is driving that 23%, you see it's customer deposits at 21%. So it's like 1-for-1. The growth in customer deposits to the growth in balance sheet or growth in total assets. And that really reflects the trust, the confidence that Equity Group enjoys, the safe to secure place status that the group continues to enjoy. Earlier on, in the first quarter, we were talking about mark-to-market impact of the Eurobond. As we can all see, that has significantly reversed. And as I said, then that was a timing difference as you recognize this. And with that explains the growth of shareholders by 29%, because mark-to-market is normally netted off against shareholders. FADs doesn't go through the P&L, but that has reversed substantially during this quarter. Again, speaking that this balance sheet reflects the global macro environment in which we are operating. But what I wish to draw your attention to is that, well, equity has received increased funding by 23% during the period, nearly 300 billion. Most of that money has gone into loans, and that is why net loans to customers have grown to 26%. This speaks of equity's position, that you don't avoid the risk, you manage risk. So equity doesn't abandon its customers because the environment is challenging. It works with the customers to wade through a turbulent time and maybe to take advantage because of that support to position themselves. And that explains why net loans have gone up by 26%, because we feel we should never at any point in time detract our customers from their dreams. It's their dreams, we fund them, but manage the risks of the environment during that time. But the excess funding, as we can see, growing faster than the uptake by our customers on loans, has caused a growth of 33%, giving the group an opportunity to invest in government stock and government securities during very good times. Now, as we turn the page, I want to again demonstrate the parallelism that loans are growing by 26% and a corresponding growth in interest income when we turn to the P&L. But we quickly see interest expense is growing faster than interest income. There's always been arguments, why is equity increasing interest rates? Equity doesn't increase interest rates to increase profits. It increases interest rates because the market has moved. It's prudent management that you never undermine market forces. As we can see, interest expense has grown at 54%, 2 times faster than interest income. We're not trying to match any, it's not objective to drive, but it's to recognize the market prices of interest rates, exchange rate, and inflation. Those are the ones that you allow to play into your balance sheet, into your operations, reflecting the size of the group to allow transmission of monetary policy that the government adopts. When the government increases interest rates, gives 3-year bonds or issue 3-year bonds at 16 and 17%, it means that you can't undermine the sovereign risk rate of 17 by issuing interest rates lower than that, and so that reflects. But when you do that, then the cost of funds also reflects the sovereign risk rate. And so that explains why interest rates have gone up the way they have gone. It also reflects the global markets, where you have, as we know, equity has nearly 50% of its loan book funded in dollars. Again, it reflects the rise of the RIBOR from 0.25 to nearly 6%. So you could see 600 basis increase in cost of funding. And we see the prudence of the management as they navigate the growth in loan book. They want to continue to increase loan book, but recognize these are challenging times. And challenging times require prudence. And as a result, we see loan loss provision increasing by 89% as a recognition. Yes, we have very good loan book. It's remained substantially at 9% NPLs, but these are difficult times. So be prudent enough, make the right provisions as you read, recognize the risk, and continue reading, because we have made a commitment to the customers that we are in the business of intermediation. Business of intermediation happens all the time because customers are driving their dreams all the time. So essentially that explains. We also see staff cost growing by 32% on two accounts. Take care of your staff, then they will take care of the customers, but also strengthen the capability, the competence of management to be able to manage up. The group has grown by 23%, reaching nearly 1.7 trillion shillings, slightly above 10% of the GDP of the country. You need a competent, capable, experienced, and knowledgeable leadership team. And that rising cost explains the acquisition of such talent into the market. The 33% other operating expenses really reflects inflation. Inflation, as we have seen it, yes, it has started declining, but it's still on the upper targeted number, above 7%. And that then reflects in the operating cost as people adjust. But inbuilt in this number is cost like imported inflation, reflecting the turbulence in the global market. And that gives us profit before tax of 35 billion shillings compared to 31 billion shillings last year, 30.9 versus 35.2, a 14% growth rate. And we said that then if you look at that, and particularly when you apply tax, then you'll have a profit growth of 8%, 26.3 up for 24.4. And that's what we were saying. We really don't target profit. Profit is an outcome. We focus on serving our customers. We serve on doing what needs to be done. And that explains why the balance sheet grows by 23%, but profit after tax grows at 8%, almost a third of what the balance sheet is growing, because we want to fulfill our mission, we want to live our purpose, we want to strengthen our brand, and our brand is a promise kept. You don't withdraw an umbrella when it's raining. During challenging, risky times, you start with your customers. And that reflects a return on equity of 27% and a return on assets of 3.7%. Very impressive performance. So performance is not always looked at growth in profitability. It's what is the return on equity. Performance is measured in return of equity. So it means that for those who have invested in equity, despite the challenging times, their wealth has grown by 27%. And that really then reflects maybe the best option in the marketplace, because even government is giving 17% in terms of treasury boards. Now, looking at the position of all that balance sheet from a regulatory point of view, we see efficiency in the way the yields on loans, government securities, and earning assets have continued to increase. So we are managing that macro turbulence very well, that the prices don't adversely affect and don't threaten the bank. So the yields, as we can see, there is an increase on yields on loans to 11.9 from 11.4, yield on government to 11.1 from 10%, and yield on interest earning asset from 9.7 all the way to 10.7, showing the sustainability of the model. It's difficult times, but the model continues to reflect the strength, it reflects the efficiency, it reflects the strategy that has been deployed despite the very steep cost on cost of funds and cost of deposits that we have seen almost doubling. And what we have preyed on is the ability. So it's not just the engine that is very efficient, but the buffers that financial institutions need to have during difficult times are at their best. We have seen the strength of management, the strengthening of the management with greater experience, knowledgeable people to help manage this, the environment. But we have seen the quality of the asset book, holding at 9.8% non-performing portfolio compared to average industry of 15%. We see strong NPL coverage, and we see the risk being passed through the profit and loss, cost of risk at 1.9, the prudence in management, while at the same time we see liquidity reflected by two numbers, loan to deposit ratio of 69.5, liquidity of 51%, showing the agility of the group to withstand prolonged shock. At the same time, we see core capital to risk-weighted asset at 15% against regulatory minimum of 10%. So we are registering capital buffers of 50% above the minimum capital requirement. So again, the ability to absorb shock, the ability to sustain growth of 23% or even faster growth is well inbuilt within the system. While total capital to risk-weighted assets start at 19% against a ratio of 14.4. So broadly 500 basis points over and above the capital requirement. Very, very strong buffers to support. The most fulfilling part of releasing these results is the knowledge that the management seems to fully understand this bank. They seem to understand the dynamics of the environment. So when you look at the guidance the group gave at the beginning of the year and the actual performance, the group is on track. So, and that is the simulation where I would say you simulate environment. So we had projected a loan growth of between 25 and 30, we are at 26, a growth of deposit of 20 to 25, we're at 21, non-funded income of 40 to 43, we're at 43.5, cost income ratio, we had projected 40 to 45, we're at 49. The effect, like we said, of inflation, the cost of staff, those are the two biggest drivers. But when all that is put together, equity has delivered on its promise of return of equity. It had projected between 25 and 30, and it has delivered 27.7. And cost of risk, that's what we could have maybe blown the promise, is high, reflecting the prudence. We had projected 1.5 at maximum, we're at 1.9. NPLs, we had projected between 7 and 10, we're 9 at 8. But the most fulfilling promise is subsidiary contributions. which we had projected between 45 and 50. We're at 46. P&L, or profit and loss, we thought subsidiaries would be contributing a maximum of 35. We're at 45, suggesting the subsidiaries has matured faster than we had thought. It's a perfect replication. Economies of scale are playing out. And so the more we see growth in the subsidiaries, the greater the momentum of profitability, because they are delivering above the target. The two strongest subsidiaries in terms, well, every subsidiary has done very well. We really appreciate the great turnaround that has happened in Tanzania. I want to draw your attention to Tanzania. Isabella, maybe Isabella, you could start. Isabella, 2 years ago, we invited her to come to recognize her. She inherited NPL, so non-performing loan book, of 36%. She's down to 16%. A huge transformation within a period of 2 years. Isabella, thank you very much. We really feel proud. We have also seen the momentum deposit growing at 30%. People say about Tanzania, that is the Tanzania we know ourselves. But I think the greatest contribution Isabella has done is really recruit very gifted, talented management that has not only managed to reduce NPLs, but to register very significant growth. We have seen Rwanda being the fastest growing of the old subsidiaries in profitability. Balance sheet, Uganda being the fastest growing of all those subsidiaries. But as we had predicted, the outperformance have been by DRC. And DRC seems to be moving very comfortably. 60% of the balance sheet of Kenya and almost 50% of the profitability of Kenya. So DRC has come through beating all the expectations. But the new kid on the block, the insurance business, if we have seen, we thought the model was proven last year when ILAC, or Equity Life Assurance, registered a 68% return on equity after only operating for 9 months. We see this year that last year's performance have been delivered in 6 months, suggesting that we'll see better, much better results. And that is what has encouraged us, that seems the life business is stable, the model is tested now twice, we can go for general insurance, focusing a lot of health. And Ajara, maybe we could start. We really deeply appreciate this diversification on lines of business. Shareholders can see it, knowing that if there's challenges in banking, the insurance business. So we are seeing the insurance business, and our prediction, the way we predicted by 2027, DRC will be bigger than Kenya. There is a possibility insurance business will be bigger than the banking business by 2030. We seem to have got the model right, or we have got the right leader. Ajara, which is which? Both. We've got the right leaders, we've got the right model. The group structure seems to be doing well. And maybe, thank you very much, Ajara. And say, we have been kept on our toes by our risk group. Or maybe I will ask the risk managers, our directors, starting with Sam, Wafura, Emmanuel. As you can see, the most seasoned bankers in equity are the risk managers. And they have kept, is Derma on the line? Cyber. We are also celebrating Charles. We all know the country has gone through very difficult times. I think the last 1 month of cyber attack, and equity, we have been resilient, not giving way, and that resilience, again, is reflected by this very, very experienced team. But as we saw in the P&L, that team also comes with the cost. But for the customers, financial cost of staff is negligible compared to what Kenyans went through, customers of other institutions went through the last 1 month in terms of cyber. We are celebrating them that throughout consistently our systems have held when we are seeing the country under huge pressure from global cyber. So let me request you to help me recognize this team of very seasoned, highly experienced people. Wafula is in charge of control environment. Wafula in charge of compliance. We all comply with the rules. You manage risk by having processes and procedures. We recognize the credit risk. Emmanuel, you can start, Emmanuel. People see, we really are singing your praises because of where you have, and Sam Kitwekere for the entire group risk framework. Earlier on, we said our largest income has come from trade. Where is Shemeka? Shemeka, thank you very much. 146% growth? 117. Thank you very much for correcting me. You don't want to take more than your share of credit. That's what you call integrity. So even when you give somebody, you say, no, 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 this is not mine. And we are seeing that with the customers. If you overpay customers, they are returning money. And that is real integrity at an enterprise level. Is Daniel Gashao in the room? Please start. That is the Treasury Department. They have really pulled through to manage a portfolio of half $1 trillion shillings. Treasury is managing government treasuries $500 billion shillings. And as we saw, despite the huge challenge, they don't have, mark-to-market is declining. They seem to have managed their portfolio very, very efficiently, but more importantly, their returns or yields are 100 basis points higher. And again, we can see the future looks even better than the first quarter. So we can confidently say the second half, we hope and look forward to a better quarter. Thank you very much for listening. That's our presentation. But I'm with the team here, and as you can see, the other directors are here. We also celebrate Gerard, the managing director of Kenya. Those who may not know, we separated Kenya and the group, and Gerard went and set Kenya in Britam Towers. That's where they are located. This is purely the group. So again, we have seen that separation work very, very well. So where we are, this is a non-operating company. So for those who have always asked, James, if you move out of business, what will happen? The business moved out of me. I didn't want to move out of business, but the business moved out of me. So Gerard went away with the business, but looks like we are still doing pretty well. So that is the dynamics that we have seen. Last week, we celebrated, because sometimes you have to say it, because if you don't say it, it hasn't happened. We sent 98 kids or scholars to 28 global universities. We took pride that Preston University, arguably the most prestigious university on earth, admitted 3, Harvard admitted 3, Yale admitted 3, and on and on and on. Out of 98 scholars, 18 of them went to Ivy League schools. So despite the microeconomic environment being very tough, we are still living to our obligation of investing in the future of our people, supporting communities. That 98 scholarships costed 2.5 billion Kenya shillings for the 4 years that those 98 kids will be out of the country. So again, we feel the partnership between Equity and the public. Beth, maybe you could start, we recognize, Dr. Beth Waweru leads the education pillar. Herself, she went to Yale. Looks like she has an agreement with Yale to support her with 3 kids every year. And thank you very much, David. Dr. Ayuka. Now, Dr. Ayuka has helped us a lot. We used to have 3% of our loan book being in agriculture. We now have 16% of our entire loan book being in agriculture. We want to catalyze agricultural transformation. This continent will not transform without a focus on agriculture, enable agriculture, make agriculture resilient, make agriculture sustainable. And they work very well with Leshma. Leshma, you could stand with our group director of sustainability so that farmers are helped to adopt climate-smart methods to mitigate and adapt to climate change. And while the country is celebrating increasing food production, particularly of maize, from 41 million bags last year, 32 million bags last year to 41 million bags. We take pride that we have partnered with the government and played a very huge role to really secure food security for our people. And so hopefully by October, we'll lead better inflation because maize in the Rift Valley will have been harvested and will have started becoming maize flour. So this team of 2 has really helped us to position. Allow me to request you, we recognize their great contribution. Thank you very much.